Yo, what's up guys? So this is a continuation of last week's discussion where we'll dive deeper into the concepts of time frame alignment. Time frame alignment is crucial to CRT and ICT trading as the precise functionality of these concepts relies heavily on properly integrating them through accurate time frame alignment. If you're not aligning timeframes correctly, you won't be able to integrate these concepts in the most effective way. To master how these concepts fit together, you need to fully understand proper timeframe alignment and how timeframes work in combination. Let's break down timeframe alignment. For each trading style, there are 3 primary active timeframes along with other pair timeframes. These won't be the only timeframes that you use, but for beginners, it's best to focus on these key ones. The 3 primary timeframes are the higher, intermediate, and lower timeframes. These higher timeframes serve 2 key functions: identifying CRT and spotting key levels, which you then merge and integrate into your overall strategy. Next is the intermediate timeframe, which is used to determine structure and order flow. At its core, structure refers to whether the price is breaking highs and rejecting lows, or rejecting highs and breaking lows. We'll cover structure in more depth in a future episode, but that's the fundamental idea. Finally, the lower timeframe serves 2 functions: market profiling, where you use market profiles to anticipate future movements, and then entry setups, which is where you execute your trades. This is the time frame that you'll use to pinpoint entry opportunities. These 3 main time frames are essential for our style of trading, particularly for beginners, though you will also use higher time frames as well as you gain experience. Let's now break down the time frame alignments for different trading styles in more detail, starting with swing trading. For swing trading, the higher time frame you'll use is the monthly chart. The monthly chart serves 2 main purposes: identifying key levels and finding CRTs. Next, the daily time frame acts as your intermediate time frame, where you'll analyze market structure and order flow using various concepts. Finally, the lower time frame for swing trading is the 4-hour chart, which will be used for market profiling and identifying entry points. In swing trading, these are the primary timeframes necessary to conduct a comprehensive top-down analysis. By following this approach, you can structure your analysis effectively as a swing trader. Next, let's move on to short-term trading. For this style, the weekly chart is your higher time frame, where you will mark out key levels and CRTs, aligning them for better analysis. The 4-hour chart is your intermediate time frame, where you'll determine your structure. Finally, the lower time frame is the 1-hour chart, which will be used for market profiling and taking entries. Now we come to intraday trading, which happens to be my personal style. I don't want to push any specific method onto you. Finding your trading style is a personal journey that comes through experience and self-reflection. For intraday trading, the higher time frame can be the daily or the 4-hour chart, although I personally prefer the 4-hour chart. If price action is unclear, you can switch to the daily chart for a broader perspective. The 1-hour chart serves as the intermediate time frame for analyzing your structure, while the 15-minute chart is used for your entries and market profiling. One crucial point to remember: even as an intraday trader, you should still analyze the monthly, weekly, and daily charts. These charts provide a higher level perspective and help form a directional bias, but your core timeframes as an intraday trader will be the ones mentioned above. Finally, for scalping, the correct timeframe alignment is as follows. Use the 15-minute chart for marking key levels and CRTs, the 5-minute chart for structure, and the 1-minute chart for profiling the market and taking entries. Moving forward, here's a visual representation of how timeframe alignment works. We have 3 main timeframes: the higher timeframe, the intermediate, and the lower timeframe. To recap their purposes, the higher timeframe serves 2 key functions: marking key levels and identifying CRTs, while integrating these with other timeframes. The intermediate timeframe is used to assess market structure and build conviction in your analysis. Then we have the lower timeframe, which focuses on market profiling and identifying entry setups. All 3 timeframes are applied in a logical framework, working together to offer insights and a more comprehensive understanding of the market. Now, for example, if we are scalping, the higher timeframe would be the 15-minute chart, the intermediate would be the 5-minute, and the lower timeframe would be the 1-minute. This is how you utilize them effectively. Let's now go over some charts, and I'll provide you some examples of timeframe alignment, starting with intraday trading. You'll begin by conducting higher timeframe analysis to establish your directional bias, starting with the monthly, then the weekly, and finally the daily timeframe. From there, you'll move down to the 4-hour timeframe, refining your analysis to develop a trade idea, either aligned with or counter to that directional bias. Risk management will be crucial, shaped by these factors. For intraday trading, the 4-hour chart is the primary higher timeframe. Here, we identify key levels and match them with a CRT before moving to the intermediate timeframe to assess the structure and incorporate timing elements. Finally, we take our entry on a lower timeframe based on a profile setup. On the 4-hour chart, you can see that we've taken out this high, establishing a key level. Following the break of this range low, we observe an expansion. When the range low is breached, the draw on liquidity gravitates towards the 50% level of the range and ultimately the opposing end of it. However, before price continues higher, to take out the opposing range high, it typically undergoes a retracement, since price doesn't move in a straight line. Even if the higher time frame draw on liquidity is higher, price will likely retrace before making its move towards the range high. Another important factor is that we've taken out an internal range high during the New York kill zone. Price action in the New York kill zone and the London close kill zone often leads to reversals or retracements in such scenarios. So in this case, you anticipate a retracement on the higher time frame, which would appear as a reversal on the lower time frame. To confirm this, I first align it with a key level on the 4-hour chart, which is this high right here. Then I identify the CRT and matched it with the same key level. Both of the necessary functions for the 4-hour time frame were completed. This forms the foundation of your higher time frame analysis. Next, you transition to the intermediate time frame to determine market structure and factor in timing elements, which allows for a more precise view of the price action. On the 1-hour chart, for instance, by incorporating opening times, you can see how at 5 p.m. the market opened with a ranging profile followed by an expansion. This expansion took out the equal highs during the second half of the day. Now, even though the higher time frame liquidity target is higher, we still expect a retracement before the price continues upward. Then we shift to the 15-minute time frame for profiling and entry setups. On the 15-minute chart, you can clearly see different profiles: a ranging profile followed by an expansion profile, then a retracement profile, before another expansion upwards. During this expansion, we tested a key level, which was the 4-hour inside range high. Based on market profiles and the integration of key levels, the likely outcome after price tests a key level with an expansion is a reversal profile. Given these elements, you would anticipate a reversal. However, instead of entering a short position immediately, you would wait for confirmation through your entry model. In my case, I use a Model 1 entry, which is based on the formation of an order block, as seen here. This is how you effectively use time frame alignment. Throughout this video and the last one, I've detailed the process of aligning and selecting different timeframes to suit your trading style, as well as explaining various trading strategies. I hope you did find this informative and enjoyable. If you haven't done so already, please consider liking this video and subscribing to my channel to not miss out on future content. I do upload an indicator video every Wednesday and an ICT Concepts video every Sunday. I'm currently making a mini-series on candle range theory, which is what I trade on a day-to-day basis. If you would like to keep up to date with my trades, then follow me on Twitter or join my Telegram. Thanks for watching. Till next time, happy trading.